Good morning, everyone. Welcome to ElysianNxt Webinar, together with guest speakers from Deloitte Thailand. We are here to discuss about how ESG will be applied for sustainable finance in Thailand, as well as the ASEAN Green Taxonomy and much more. Before we start, I would like to cover some general rules. Yeah, the recommended browser is Chrome. If you're having any technical issues with another browser, please switch to Chrome if you can, or try refreshing your browser. And if you're having any other issues, please use the chat box on the bottom right corner, and we will do our best to assist you. The session today is being recorded, and also the presentation will be shared with you in the next few days. And if you have any question for the speaker today, please feel free to ask them in the question tab on the right. And all questions will remain anonymous and will be answered at the end during the Q&A session. So in this session, there will be 4 speakers. And firstly, I would like to introduce Kun Thitachai Apipongcharoen, who is the expert from climate and sustainability from Deloitte Thailand. Kun Saran Bunchalakun Koson, who is the master of financial modeling, also from Deloitte Thailand. And from ElysianNxt, we have Kun Pete Mandeville, who is specialized in risk product and financial system implementation, and I, Anachari Dongkamsawat, with background of financial modeling and stress testing, including with system implementation. All right, let's start it. Our session today will cover 4 topics. As you can see in the agenda, we know that ESG is currently a main topic and a huge challenge for the financial sector to prepare for environment-related changes along with Thailand's goal of achieving carbon neutrality and net zero emissions. The Sustainable Finance Initiatives for Thailand is a significant starting point for further collaboration between the regulator and the financial industry to advance the development and implementation of policies that will direct the future of the Thai financial system towards sustainability. And from this initiative, the Thai financial sector will play a crucial role, especially to be able to effectively manage financial risk stemming from climate change, resource depletion, environmental degradation, social and governance issues through the adoption of a robust risk management frameworks that properly monitor, report, and verify ESG and opportunities, where the immediate focus is on the managing the risk of losses due to climate change through physical and transition risk. The longer term aim is for the financial industry to seize the opportunities of transition and direct funding towards sustainability. So we will starting with the Bank of Thailand latest initiative for sustainable finance, including the ASEAN Green Taxonomy that Kun Thitachai will walk you through.
Okay. Thank you, Kun Anachari, for the introduction. So, hi everyone again. I'm Tita Chai. I'll walk you through this Bank of Thailand direction towards sustainability and ASEAN Green Taxonomy. So you can see from this slide, the banks and investors are looking more into ESG, right? It has been intensified in recent years. Either it's banks, investors, regulatory bodies, businesses, and NGOs. Also, the governments become more attuned to evaluating investment and corporate performance through the lens of ESG impact itself. So on the left, you can see the three main pillars of sustainability, as you can see, the environmental side, social and governance, right? So for the environmental, it's about climate change, carbon emissions, water. That's some of the example. For the social side, it relates to human capital, labor standards, human rights. And for the governance part, it's about the business ethics, basically. Mhm. And also bank and investor, they want to reduce these negative effects on each side, either it's from the lending and also the investment portfolios. And they want to encourage more responsible business practices. You can see the bar chart on the right hand side now. Basically, it's a bit old, but the trend is still the same. Asia is trailing Europe and North America in ESG investing, right? So for the global sustainability, as PI has mentioned, it's around like 70 trillion US dollars now, supported by around 2,000 signatories to support the ESG investing. Mhm. And I'll walk you through the next slide. Uh, So this one you can see it's like there's the ASEAN taxonomy was developed. It serves as a common building block that enables transition and fosters sustainable finance. It was adopted for the ASEAN member state, right? I don't want you all to like be like scared of this. It looks a bit hard. It looks like there's a lot of things to be considered, right? But basically the green taxonomy is a framework for defining what can be called the environmental sustainable investment. They want to tackle the greenwashing so everyone would have the same standardized things, right? So basically, I can just give you some focus of the way how it works, just an overview quickly. For the left hand side, the environmental objectives and the essential criteria. So in each activities that would support either climate change mitigation to either reduce or abandon it, right? The climate change adaptation, how can a company works toward it if there's a climate change impact or the risk that happens. The third part is the provision of healthy ecosystem and biodiversity. So we have to care about the natural biodiversity as well, the environment surrounding the companies. The last one is the promotion of resource resilience and transition to circular economy. So we want people to be more use the resources, just get it back into the loop like that. Also to help support the waste reduction as well. And the second portion is essential criteria. So we would like to know that these things will not have significant harm. Activities will not cause any significant harm, and also remedial the measures of transition. And then after we consider this, there will be the decision tree making. It will become a part of the foundation framework. So the bank can make decision now whether it's green. This activities are green, but it's good for the companies or people who are asking for investment. It's an activities that help climate and also do no harm like that. For example, it's the green colors. For amber, it's the middle one. They may have some effects still, and for the red one, it's like no good, no go like that. And if you want to go deeper, it's called plus standard. So this box, it's a threshold. We have to go focus on the each sectors. So or for example, several countries, even in Southeast Asia, right? We have different regulatories, we have different standards, different electricity usage, the sources where it came from, right? So the effects would be different. And then we would also do another decision tree making, and it will become like tier one, tier two, tier three, and could be able to classify which color they are. So for the bank and investors to make better decision making, the European side has already done their own EU taxonomy, but ASEAN is like doing it now, approaching it towards to be standardized soon. And I'll show you on the next page. It will be about what Bank of Thailand has just issued the direction papers from the last month, I think. 2 months ago. Yeah. So this is the Bank of Thailand's directional paper in August. So basically, it revolves around the financial sectors, right? They want to transition towards environmental sustainability in the new Thai financial landscape. Sorry. So there are 5 points. The first one is adjusting the business operations for the financial institutions. So basically, they want products and services that are prone towards environmental friendly, social, also supporting social aspects as well. The second part is taxonomy. That's what I'm talking about. What Thailand can learn from is we can use the ASEAN taxonomy as a whole ASEAN member state. So it will come soon, and the financial sectors need to understand it as well. Mm. The third part is the data platform, which our other speakers would talk about as well, because we want to understand what risk would be for the clients or even for the portfolios, right? For the bankings, right? So we would like to use this data and then later on it could be used as disclosure standard as well. The fourth part is they want an incentives to support these kind of activities. Yeah, the companies want to do green, for example, green implementation of using renewable energy, plantation, right? They need some incentive to support on this too. And lastly, the knowledge management and skills like building capacity of the financial sectors practitioners should be increased as well. This is the what Bank of Thailand have already launched that they want to gear toward this, and then we would see what next speakers have in hand to share with us about how can we move toward this. Yes, thank you, Kun Anshri.
Yes, as Khun Thitachai mentioned, from the Bank of Thailand's perspective, Thai financial sector play an important role in channeling capital flows towards sustainable growth and development. The Bank of Thailand also recognized their role in supporting the financial sector to better recognize, measure, model, and monitor these risks to limit potential negative impacts on their businesses, environment, and society as a whole. So the next topic we'll talk about the connection between the ESG and financial modeling, which will be covered by Kun Saran.
Thank you for putting Ashari. I'm sorry, I forgot to unmute the microphone. Good morning, everybody. I'm Saran from Deloitte. I'm actually working in the financial risk modeling practices. I'm serving banking and financial institution clients, especially on the area of credit risk modeling. So let me share with you my recent observation from the industry this year. As I talk with our clients, they're focused on this year on credit risk modeling. Still, the computation of parameters for both regulatory and monitoring purpose, based mainly on historical data. For example, the historical payment behavior, the collection details, the collateral values, and they are addressing the ongoing challenges for this year, such as the treatment of customer payment data, because during the past 3 years, we have multiple series of debt moratorium during 2020 and 2022, and that somehow affect the performance of those credit risk modeling, which banks and financial institutions are putting much effort to tackle these problems. Another consideration that banks are taking as a priority for this year still be about the abrupt change in global macroeconomic landscape. Since the war between Russia and Ukraine began in February 2022, it created impact on numerous areas like the supply chain disruption, higher inflation, and volatility in the FX space, especially from the rising US interest rate. So the impact of those factors have been pronounced in the credit risk modeling, and banks and financial institutions divert time and resources to mitigate those issues. There are also another factor such as the recovery, which is unequal between each industry. The tourism industry seems to be recovering quite late when compared to the IT industry, for example. And there will be a lot of discussion about the future customer behaviors in the new regime and whether or not those models should be calibrated. As you can see, the ESG consideration has not been taken into account as much as it should. So on the next slide, we will be talking about the current consideration and the current findings from ECB climate risk stress testing. So the ECB, or the European Central Bank, earlier this year has performed some stress testing in the area of climate risk among more than 100 European banks. And the finding has shown that there are still some deficiency, such as policy, and the most important one is a data gap, although some of the progress has been made. So the current findings, which are worth highlighting today, is the lack of clearly defined long-term strategy to credit allocation policies, because some of the banks are still depend on revenue from financing carbon-intensive industry. If the ESG practice has gaining some momentum, the revenue from carbon-intensive industry during the transition period might be jeopardized. And the next one is the integration of climate risks into the overall bank-wide stress testing frameworks and credit risk model. It is still be in a very early stage. And due to the granularity of data, which is still not much yet, especially for some certain countries, there are still extensive use of proxy data. So if we are about to cross this gap, so what is the idea to start your ESG initiative effort on this? So we have few idea to be suggest. The first one is the ESG data strategies. Since the granularity of data is still a big problem, so the bank should think about having some strategy in data collection, incorporation of scientific data into the assessment as well, because in the future it will not be just a payment data, it will be data from another discipline, such as engineering data and scientific data, that should be incorporated into the climate risk model, which is again incorporated into the overall credit risk model. The next one is the optimization of weighting based on historical data and industry-specific weighting. So since different financial institutions are having different exposures to each of the sector, so you should be think about the appropriate weighting that you should give to certain industry to measure like revenue generation and exposure to those industry. Next one is the incorporation of climate risks as a factor in loan granting process. The ECB result has shown that less than half of the bank has already incorporated these climate risks as a factor when they consider granting the loan process. And the next one is the consideration of revenue generation from pollute-intensive industry versus green industry. So this is different on the definition of green industry. There is no consensus right now on what should be defined as green, but one idea to start with, some of the European bank has counted the emission per a unit of revenue, like for example, the carbon dioxide release per 1 million euro of revenue. That should be one of the proxy to be defined which industry is pollution intensive and which one is green industry. And environmental characteristic of the bank exposure, the bank should start with like having a comprehensive picture on where is the source of the revenue from. Does the source of the revenue from industries such as coal mining or more toward green energy? And the last one is what I've mentioned, the incorporation of scientific environment data in every aspect of the modeling process. Why? I will show you the next one. So more recent example about the recent catastrophe. This one is quite related into our country in Thailand. We have foreseen extreme weather event, and extreme weather events are more likely to happen when sea level is rising and the ocean temperature is warming. Just last month alone, Asia had witnessed two major typhoon landfall. The one is Nanmadol in Japan and South Korea, and another one is Noru across Southeast Asia. This create quite a big devastation to the affected area. And going forward, typhoon are likely to be traveled inland further than they did in the past. So there will be more area that are exposed to the risks of immediate flooding, for example, and the collateral value on this area should be re-evaluated for the impact. Just another example in Europe, as some of you may have already been aware, European countries are facing energy crisis this year, especially the electricity price. So in some part of the world right now, the energy efficiencies of housing and mortgage might be a determining factors for the real estate price and liquidation times, because there were studies that show that energy efficient properties will have lower payment areas when controlled for another factor, such as the income of the borrower, for example. In some certain European countries, there are bills that are about to be effective in 2023. This bill will exclude from rental market any property that does not comply with a certain maximum energy and carbon consumption level. So banks and financial institutions will be more hesitant toward granting loans for those inefficiency properties. Okay, so I think it is all for the financial modeling impact on the ESG side. And the next one is a practical approach. So I'll return to Khun Anachari, the moderator. Thank you.
Thanks, Khun Saran. So as Khun Saran explained earlier, it is a big challenge to incorporate the ESG into financial modeling through climate stress testing, since ESG stress testing is not a once per year exercise that the banks do manually. It requires a continued adaptation and fine-tuning of various climate scenarios. The next agenda, Khun Pete will walk you through some practical consideration and key capabilities for climate risk stress testing to be a part of the operational risk management as prescribed by the Basel Committee as well as the Bank of Thailand.
Thanks, Khun An, for the introduction. I will indeed try to use my time to offer a little bit of a link between the previous section where Khun Saran outlined the challenges of the internal credit risk modeling aspects of ESG, towards the last topic of the agenda, which then talks about how the ESG is taken into consideration in the overall decision-making process of financial institutions. The BCBS in their June guidelines, they have called that link the climate stress testing framework. So in their paper, The Principles for the Effective Management and Supervision of Climate-Related Financial Risks, the BCBS has really laid out 18 principles that are guidance for banks in how to build out a effective climate risk stress testing framework that is suitable for supporting the business decisions that we are seeking to incorporate. So today we will be zooming in on 5 key capabilities that we think are essential capabilities in the building out of such a climate risk stress testing framework. And we will try to do that on the basis of some practical examples. I think in the previous section, Koen Saran already gave some practical examples of physical risks and transition risks and how they might impact the risk exposures of banks. So we would like to centralize around 5 key capabilities and demonstrate using some practical examples. So the very first key capability that we want to address as part of the overall climate risk stress testing framework that banks should be considering is quite potentially obvious, even trivial, but nevertheless it is something that is a very key aspect in our opinion of a climate risk stress testing framework. It is the capability for users to set up simulation environments. Because we are seeing that when we talk about the impact of climate risk on the risk exposure of banks, we are very often talking about primarily the credit risks. Many climate risk stress tests are talking about the expected credit losses as the primary measure of how climate impacts the banks primarily. And we also often see that within these credit risk platforms that banks have installed for regulatory purposes, that more often than not, users are sometimes struggling to do real stress testing on these credit risk exposures. And certainly from a need from a climate stress testing capability onwards, because we all know that there is a large level of granular data that is needed for modeling your climate risk stress tests. So that means that somehow for a user, when you want to effectively measure the impact of climate risk on your expected credit losses, we do believe that it is essential for a user to have that ongoing capability to always start from the regulatory ECL and basically start to measure the impact of climate risk on that regulatory ECL by doing that in their own simulation environment. So we can have a look at how this practically could look like. So if we, for example, start to look into a solution, you can see, okay, we are starting from a regulatory calculation for ECL for a certain reporting date, which is a regulatory calculation. In our terminology, we are calling that a deck. And within that deck, we are containing all the results for that ECL calculation. So that deck should be the basis or the starting point for a risk users to start simulating or stress testing the climate risks. So important for that is that the deck also contains the links with the underlying models that are used for the calculation of the regulatory ECLs, so that there is only one place where the user can see all the configurations, and that can basically change these configurations, as we will see later on in our demo. So the user can now go in and clone that deck to basically set up their own environment to say, okay, I want to start from my regulatory ECL. I'm going to clone that deck, so all the results and the underlying configurations. I'm going to give that my own name. And more importantly, I'm going to tag that as a simulation deck type. So that makes it completely separate from a regulatory deck type, where the user now creates their own deck, their own simulation deck. They can also restrict the access level to everybody can see what's happening in that deck, or only I can see what's happening in that deck. So by simply clicking on the add deck, you have now created your own simulation environment. And as you can see, that simulation environment has all the same configurations copied over from the regulatory deck. So we can now start recreating the same results as our base ECL. By rerunning the calculation for the same reporting date with the same configuration. So that will give us the same like-for-like results as the regulatory ECL for our initial baseline setup of our simulation deck. So we can see now we have recreated our ECL numbers. We have done that in our simulation deck. So now we are set up to start configuring our several climate risk scenarios. So you can see that we have now the two separate decks, so two separate environments standing next to each other. So now I have my complete contained individual simulation environment where I, as a risk user, can start playing around with the configurations. Yeah. So that brings us to the second key capability that is part of the climate risk stress testing framework that banks will have to incorporate into their BAU risk operations, which is the definition of the climate scenarios themselves. So now I have set up my simulation environment, my simulation deck. So now it's a matter for a user to easily implement different scenarios, because one of the principles that the BCBS has put forward in their guidelines from June this year was that as part of the BAU risk operations, banks should make use of scenario analysis to assess the resilience of their business models and strategies to a range of plausible climate-related pathways. So a range of climate-related pathways is a moving target, because I think already in the previous section, Koen Saran already mentioned that the uncertainty and the impossibility to forecast many of the elements in the climate risk evolution are a key challenge. And that key challenge means that users will need to have the capability to easily assess the impact of a multitude of climate risk scenarios. So let's have a look of how that could be made easily available to a user in the simulation deck that we have created in the previous step. So let's go and have a look in our simulation deck, where we now we have our established base ECL, our primary or regulatory ECL. And now we want to start creating, or what we will first do within our regulatory deck is remove one layer of complexity. We want to compare the non-weighted ECLs, the BAU ECLs, because that isolates the weighting complexity from the regulatory ECL. So first we are unweighting our ECL, and now we will start implementing our climate or physical risk scenarios to assess under a BAU scenario, what is the impact on my ECL of certain physical risk scenarios. So I'm creating an ECL group, as we call it, and that group is meant to measure the physical risks specifically. And within that group, I will now start adding my individual scenarios. So for example, a flood risk scenario in the north of Thailand, referring to the typhoons and flooding that was already mentioned. So for that certain scenario, I will give a certain weight or probability of occurrence. And as mentioned, I will use the BAU ECL scenario to run that impact analysis, because I only want to compare with my BAU regulatory ECL. So now within the same physical risk group, I will add one more climate scenario, which is more of a flood risk, but a more severe flood risk. And I am starting to add the configurations, so the probabilities of that scenario of occurring. And also here, I am going to make sure that the ECL calculation under that flood risk, severe flood risk scenario is also using the same BAU economic scenario. So now we have configured our different scenarios for physical risk. So again, now in order to prepare for our baseline, our starting point of the configuration, we are running the calculations, but obviously the expectation is here that this will give the exact same results as the regulatory ECL, because we have not changed any of the underlying models. We just have created two placeholders or two scenarios, which now allow us to go in and do the necessary configurations for each of these individual physical risk scenarios. Yeah. So that brings us to the third key capability as part of the overall climate risk stress test framework, which is obviously from a physical risk perspective. It is very often boiling down to what Koen Saran already mentioned. It's often boiling down to the capability of easily stressing collateral values. For example, in error-prone, in flooding-prone locations, like the north of Thailand, for example, there might be some location that I really want to stress my collateral values, or I want to shift my LGDs, all in an attempt to measure the impact of my ECL of the risk of a flood or a severe flood occurring. So let's go into our simulation deck again and quickly add these stresses to our individual scenarios. So if we just go into our individual stress physical risk scenarios, we can now basically start adding these data stresses that are typically key for measuring the impact of physical risk. So what we can do here is add individual data sets. In our case, in this example, we will use a data upload, and we will say, okay, I want to upload stressed data that only applies in my flood scenario, not my severe flood scenario. Only for the flood scenario, I want to allow certain stresses to occur at calculation runtime. So I'm now asked to browse a file, or I can now upload a file easily. Say, okay, for example, in a certain location in the north of Thailand, in our example here in Khon Kaen, we are assuming certain collaterals might be reset to zero value, i.e. destroyed due to flooding. For others, we are going to change the LGDs. And I'm going to do the same thing here to upload my own stressed data set, but this time for the severe scenario, where I am going to, the same way, upload my manual data set, which is then basically using different set of collateral stresses or LGD stresses. You can see here the LGDs here are basically having a larger change. So once we have generated these or uploaded these stressed data set and linked them to our individual climate scenarios, so what will happen now is that the system will not automatically, will not change the underlying data set, because remember, we are only working within our confined simulation deck, which means that all I do here in terms of my modeling of my scenarios remains only within that deck. So I'm not touching anything outside my deck. So which means that the stressed data that I have uploaded in my simulation deck are actually now being taken into consideration in the calculations of my simulation deck. So there is no more further, there is no change of data. There is runtime application of my stressed data sets. Yeah. So that brings us to our fourth key capability, which is basically more, I think, more an advanced type of modeling capabilities that really come into play when we want to model transition risks, because we all know transition risks do manifest themselves over a long time horizon, which is multi-year time horizon, a multi-decade time horizon even, because all the way up to 2050 is where we want to project our impacts of our financial exposure towards the manifestation of certain transition scenarios. So what does that mean in terms of increased modeling capabilities on top of the physical risk data stresses? Now here we really need to have more broad view. The user needs to have all different flexibility and options to model. For example, additional stresses, data stresses, could be used to model, for example, certain corporate counterparties, dependent on which sector they might be active in, carbon-intensive economic sectors, which could be, if they are active in that sector, that they might be prone to a high carbon tax, which could ultimately deteriorate their profitability and hence their credit rating. So that's something that would manifest itself over a longer time period, and that we might want to model on top of the immediate stresses, like for the physical risks. But another thing, and more to the previous section, Kun Saran's section about the modeling, the credit risk models, we need to be able to run impacts over the long transition periods of new models, because banks will change their probability of default models, loss given default models, to make them more suitable for ESG measurement. PD scorecards could be incorporating more of the taxonomy, green taxonomy, economic activities, carbon sensitivity of the industries that the counterpart is taking for. Loss given default models could indeed be taking more into consideration when data becomes available about energy efficiencies, locations, etc., etc. So the models for transition risk will be a work in progress, and that these models will continue to change, which also means we will need to have the capability to easily change our models that are used under the different scenarios of my climate risk stress testing. A third main aspect of transition risks modeling is more about the balance sheet itself, because in the short term, we are using our snapshot balance sheet as of today. We all know over transition risk period of multiple years or decades, that doesn't really sound too accurate. We need to be able to model the behaviors in anticipation or in reaction to the different transition scenarios as they unfold themselves. So again, let's have a look in our simulation deck that we have created before, and where we have done the necessary stresses for my physical risk. So if we go into that simulation deck now, I have prepared there a second ECL scenario group, which is now called transition risk. And within that group, we have created a number of transition scenarios, from current policy to delayed transition to hothouse, but that can be any number of scenarios as we have seen before. Now, the key thing is here that basically the configuration of these scenarios under transition risk. Now we will start extending the data stresses. So the little example that I gave you about the corporate credit downgrades, same process. Could say here, okay, I want to have the capability to manually upload certain stresses of certain counterparties based on their industries, based on their EBITDA projections. They might get downgraded. So I need to incorporate that into my transition risk modeling. But what I also need to incorporate, what I mentioned before, is obviously the dynamic aspect of your balance sheet. So you need to be able to overlay your current balance sheet, current exposures to add certain behaviors. So behavior is a generic term to indicate both direct and indirect impacts on your exposures. In our case here, we are attaching certain different projections of my mortgage portfolio growth rate under the current policy, the delayed transition or the hothouse transition scenario. So this is more of a rules-based behavioral modeling of your balance sheet. That is obviously a key capability of a climate risk stress test solution as well. So next to that, we also basically need to have, like I mentioned, we need to have the capability of running these transition risk scenarios with different internal models. So again, within our simulation deck, we are now able to say, okay, I know that I cloned my regulatory models initially, but I now want to basically have the capability to easily choose different PD models or different versions of PD models or different LGD models. So that should be very easy for a user to pick and choose the model that needs to be executed as part of the transition risk ECL run. So you select here in our case an LGD model which is already adapted to be ESG compliant. So we are selecting that that LGD model. So now we can basically go one step further, where we are some delay on the screen. So we go one step further, where we also need to go not only change the underlying PD or LGD models, but we all know that how the transition will occur will have its impact on the economic forecasts themselves. And when we measure ECL, then economic forecasts, they impact through the, for example, PD curve generation. So still within our simulation environment or deck, we should be able to easily attach my own ESG set of macroeconomic forecasts to my different PD curves, for example. So you see what we are doing here is simply adding a reference data set where I'm going to select my ESG transition risk macroeconomic forecasts that I want the calculation engine to use when it generates the PD curves. So what I need to do is simply assign these new forecasts to my macroeconomic factors that are used in this specific PD curve analysis. And this is basically brings us to the overall capability to generate, also here within your simulation deck, regenerate your PD curves that I have selected in the configuration of my transition risk scenarios. So that basically brings us to the completion of our main modeling aspects of our transition risk climate scenarios. So we have not only stressed the input data, we have also added the dynamic behaviors on our balance sheet. So we have also plugged in ESG internal models into our calculation process, and we have also worked with different macroeconomic forecasts as these are linked to the different transition scenarios. So that all brings us to the final but maybe most important capability of a climate risk stress test that is fit for purpose for supporting business decisions on an ongoing basis, which is it really needs to be an easily executable process. And why is that so important? Is because we have created in our part of our demo here, which is obviously a very quick and simplified demo, but we have created 5 climate scenarios. Now, 5 climate scenarios, all of those are run on the granular data because we have stressed individual counterparties. We have stressed collateral values of individual zip codes. We have the system will regenerate the new PD curves based on my ESG forecasts, macroeconomic forecasts, sorry. So it means that there is a very large number of data points being calculated as part of a transition risk scenario analysis. And that should not be underestimated. Because if you want to execute like BCBS mandates to on ongoing basis be able to assess the impact of a range of climate pathways, as they call it. And we know that each of these calculations for each scenario generates a very large number of data points. Then obviously we cannot, we need to take into consideration that these scenarios need to be easily executable and very performant processes. So we need to be executing these scenarios in a parallel and scalable fashion. So if we go into our simulation deck again to basically execute our scenarios, then you will see that the system, and that should be a general capability, we should be able to now run the calculations by indicating which scenarios I want to run, because not all simulations need all scenarios. So you need to be able to select which ones. But for the scenarios that I have selected to rerun here, important to note is that what is happening under the hood is that the system will now calculate all of these ECL scenarios under the different climate risk settings in a parallel fashion, which makes it if we would do that in a sequential fashion, then it would be a very lengthy process, because ECL processes, like I said, are very data-intensive processes. So we need to be able to execute all of that in a parallel fashion. And then obviously you also need to have the capability of easily analyzing these results by saying, okay, for my transition risks, for my physical risks, how do they compare with my BAU ECL? So the built-in variance analysis basically showing what we would have expected. The physical risks has a major jump in your stage 1 ECL because when the house floods, the credit state of your loan does not really matter. You're going to see a large bump of your overall losses. Whereas transition risks, we can then see that these are having a more impact on your stage 2, stage 3 ECLs, because there we have taken different modeling assumptions. For example, also for the different transition scenarios that we have implemented, we have attached different projections of my mortgage business, where under a hot house scenario, we have been much more conservative into how successful that business will be in the future. Hence, my ECL would go less upward, let's say. So I think that to conclude my story on the execution part, I just want to visualize what I'm talking about, the data points generated as part of climate risk stress testing in a credit risk setting. Well, it really means that we all know ECL is a very data-intensive process to begin with, and that's our base position. Now we need to run that ECL under a number of scenarios. For transition risk, we have done that only under 3, but again, we need to be able to extend that. So that would mean that now we have triple the number of ECLs, but don't forget that transition risk is basically a forecast of your ECLs all the way to your time horizon end date, which could stretch all the way to 2050. So if you would need to do that calculation on your baseline and then on each interval within your time horizon, you can see that you multiply your data points from a mortgage portfolio of 1 million live contracts that could easily translate into billions of data points. So that's something to take into consideration when banks are building out their stress testing framework. So that's basically the conclusion of my 5 key capabilities that I wanted to address. So I hope that this gives a little bit of guidance for financial institutions, either in assessing the gaps with their current platforms for climate risk stress testing, or in the design of a future state climate risk stress testing framework. But keeping in mind that all of these are really should be all assessed in the light that this is not a once in a year exercise. It will need to be part of the BAU risk process, and it will need to be designed so that it can support the business decision-making process within the financial institution. So these are things that I wanted to highlight in my section. So that concludes my section.
So thanks, Pete. Last but not least, to inspire the financial sector authorities, stakeholders, and society to value, promote, and require the conclusion of ESG within the financial decision-making processes as a way of fostering sustainable economic development is probably the biggest challenge. So, Kun Titachai we'll talk about how to integrate the model and approach into decision making.
Thank you, Kunasri. Let's go to the other slides. As I know we have like short amount of time left, I'll go briefly quick on this. So basically, people may think about what they can do, right? In the financial sector, how firms can help clients achieve sustainability goals, right, through their business models. So I separate this. This is from one of our thought leaderships from Deloitte. So the banks, insurers, and also the asset. Oh, by the way, I forgot to pull my knife out. So basically, it's how firms can help clients achieve sustainability goals through their business models. So this is from one of the Deloitte thought leaderships. There are banks, insurers, and asset managers. For the bank side, I already have mentioned it's similar to what the Bank of Thailand and direction paper basically told, provide funding to sustainable projects such as renewable energy, right? The second one is introduce innovative financial products, same as what Bank of Thailand has mentioned. And the last one is support transformation of carbon intensive clients. This is one part of the bank side, what they can do. The second portion is the insurers, the insurance company. They can use the data and modeling to address project of the risk and opportunities, what they can do, right? About being like more sustainable to help the client as well, and also to mitigate risk from their own operations. The second one is invest in sustainable infrastructure. And lastly, to support sustainability innovation by providing coverage as well. We have to consider that to help the clients. Yep. And the last one is the asset managers. Basically, what Kun Pete has shows is related. We can use that, and also the recent opportunities from Kun Saran has mentioned before. We can conduct the ESG research to prevent greenwashing and foster fair environmental for the bonds. The second one is improve the data quality and consistency, and lastly, to invest in the infrastructure and technologies. This I would like to keep you guys at the key learning today for how to integrate this. Yes, this is from me.
Thank you, Kun Titachai. Now we would like to address some of the questions we received from the participants. So I think the first question is if the corporate runs only transition and physical risk scenario and financial impact based on the TCFD recommendations, is that able to count as stress testing?
I think I can take the answer for this quickly. For basically, T-safety disclosure is part of disclosing the strategy, risks, and opportunities, right? And also the data disclosure for the companies that are needed to. Climate risk stress testing is part of it. It's one of methodology. So basically, either the person the entity needs to disclose, they need to disclose, but whatever ways they take the risk opportunities came out from, yep, that's the part of it. Do we have any more questions?
I think we are now almost reaching out the end of our 1 hour session. So the questions that were not discussed, we'll address them after this session and we'll share our feedback to everyone here. So lastly, on behalf of ElysianNxt and Deloitte Thailand, we would like to thank you all the participants for your time to join our webinar. We hope that we provide you an insightful information as well as the tools to support your ESG stress testing. We will provide our presentation slide for you all to access as well as the recording of this webinar. If you have any other questions or inquiries, please feel free to drop us an email. We are thank you all, and we're looking forward to seeing you again in our future webinars and events. Have a nice afternoon. Yeah, bye.
Thank you. Bye.
Thank you. Bye bye, everyone.
Thank you, everybody. Bye bye. Have a good day.